overcome. We shall overcome. So do we have the paper now? Yes. Yes. All right. So ladies and gentlemen, then this is a straightforward question that we should be able to do within the very shortest time. I promised you guys in this case here to, of course, repeat the other question, but I think it will be in our interest to just ensure that we continue. So it is AFRA, April 2023, question number 5, a good question for BDA students as well. So in this case, we need somebody who will be able to share this question paper on our BDA wall. Let me know once you guys are able to share that on the BDA wall. Let me know once you guys are able to share that on the BDA wall. Are you able to hear me? Somebody is still saying sound not good. Are you sure? Are you sure? To me, I can see my sound bar is full now. Are you able to hear Mwalimu very well? Are you able to hear Mwalimu very well now? Very clear, yes. So I think the pande yako. All right. So then if you've gotten the question, it's important in this case that you always start by reading the requirement. Read the requirement. So they want us to give them the consolidated statement of cash flows for G Group for the year ended 30th September 2022 using the indirect method in line with international accounting standards, that is IS7, statement of what year? Statement of cash flows. So then this is a straightforward question that I should be able to get all the marks. My camera is not the very best, but we shall strive and work with whatever that we have. So if it's in direct method, so I know you guys will be able to write those preambles like consolidated group cash flows, the company's G group, consolidated cash flows for the year ended. I know you guys are very good at that. So for me, I know straight away where to begin this thing from. I know that cash flows, we should always have 3 sections. And the most important section, by the way, the most important section is the operating cash flows. Any company whose operating cash flows is negative. Any company whose operating cash flows is negative is a company that is, of course, teetering towards what year? Bankruptcy. So operations, those are very important kind of cash flows. So then I have here the operating cash flows. The first section is operating cash flows. So once I write operating cash flows, where should we always begin from? The profit we should always pick is what we call profit before tax. Always pick this from the profit before tax. Is there somebody who is able to see this profit before tax from the income statement given? From the income statement given, is there anybody who is able to see the profit before tax? 34 what? 3440. I'm being told it's 3440. Profit before tax is 3440. From there, is there somebody who is able to remember the acronym that we use here for adjustments? Is there anybody who is able to remember the acronym that we normally use here for adjusted for the adjustments? Anybody who is able to remember the acronym? Anybody who is able to remember the acronym that we normally use here for our adjustments? Yes, we dial God's number for food. So we dial, here we shall dial God's number for food here, And if we don't do that, then we perish. Or in this case here, you rest in peace. Yes. This is a very important acronym that can save you a lot. So you dial God's number for food, or you rest what here, or you rest in peace. You rest in peace. So there is a friend of mine who was telling me, Mwalimu, when you use in this case here God's number, or when you use God's number in this case, your students will not be able to understand very well. Now they were telling me that Mwalimu should be dial your girlfriend's number. No. We don't want girlfriends here to dial their numbers. No. They should not be on our speed dials. Now, ladies and gentlemen, we have here straight away this stands for depreciation. This stands for depreciation. We have this one here stands for impairment. This stands for impairment. Then we have amortization of our intangible assets, like this question. doesn't have any doesn't have any intangible assets. This question doesn't have, if we look at the asset schedule there, if you look at the non-current assets, we have property, plant and equipment and goodwill. So no intangible assets. So we can as well say straight away that this is zero. This is zero. Then we have in this case here loss on disposal of assets. Loss on disposal of assets. This is gain. This is gain on disposal of assets. Then in this case here, we have our finance cost. We have our finance cost. We have our finance cost. This, or you have to change it to WO here, working capital changes. Working capital changes. Working capital changes. Working capital changes. Then, of course, working capital changes, we have receivables, inventory, and payables. So we have here receivables, we have receivables, inventory, and then lastly, we have our payables like that. Let me know once you guys are able to write these components, all of them nicely. The moment I write like this, I'll be able to get so many marks, free actually, free marks. I'll be able to get free marks. Dan, Paul is telling me Dan. Juliana, great student here. Kelvin, great student. Okay. Oh, yeah. Dial God's number or you rest in peace totally. Totally. I forgot the concept of totally. You know, when you rest, it has to be total. So in this case here, we have T, totally, or you rest in peace totally. So we have here what we call the tax that was done what year? The tax that was paid. The tax that was paid. Now, of course, if I were you, if I had a big book, then automatically I would have written the other activities because there are items that you can post directly. I would have written here investing activities, and then of course I would have written what here there financing activity, but I need a bigger board, and given that I'm using a very kind of poor camera, we shall overcome, but you guys can do that. And again, remember, these other activities here, these other activities don't need big spaces. They don't need big spaces, but we shall work with what we do. We shall make with what we do. Now, ladies and gentlemen, we go to additional information. Let's look at additional. Even before additional information, there are things that I can pick. Like finance cost is normally a free mark. Finance cost is the cost that I'm seeing on the face of my income statement. Is there somebody who is able to tell me what the finance cost is on the face of your income statement? What are you able to see as your finance cost on the face of the income statement? It is 280. If I were you, I would have written here IS because this is straightforward income statement. So in the income statement, in this case, we can see a figure of 280, all of us. We can see a figure of 280, all of us. That's normally a free mark. That's normally a free mark. Now, ladies and gentlemen, after that, then I should be able to move, in this case here, with speed and read question number 1. Question, or rather, additional information number 1. We are told the property, plant and equipment comprise the following. So we can see the cost there. We can see provision for depreciation. We can see carrying amounts. We are told during the year ended 30th September 2022, G Limited disposed of an item of equipment for cash. Cash proceeds of what year? 280. How I wish my space was enough here, because I can see some investing activity happened there. I can see some investing activity happened there. I can see some investing activity happened there. I can see in this case here, there was some disposal of a property, plant and equipment item. And remember here, I'm interested in the cash flow. This is a cash flow statement. So for the disposal of PPE, I'll always take the proceeds here to this. Remember, ladies and gentlemen, here when I sell an item of equipment, I'm divesting. I'm divesting. So in this case here, what amount should I book here? This is a free mark normally. What amount should I book here? What amount should I book here? Ladies and gentlemen, what amount should I book there? What amount should I book there? What amount should I book there? I can see from Paul, a good student here, 260. 260, because you can see during the year ended 30th September 2022, G Limited disposed of an item of equipment for cash proceeds of what year? 260 cash proceeds. Yeah, it's a cash flow. So I have here the 260. And of course, the moment I can see that there was a disposal of PPE, then we have to calculate loss or gain. So loss or gain, I would need first of all the net book value or the carrying amount. So the net book value, remember this will be the cost of the equipment minus any accumulated depreciation. So the net book value, we are told here during the year ended 30th September 2022, G Limited disposed of an item of equipment for cash proceeds of 260 million. That is perfect. The equipment had cost 750 million. So the cost of this equipment here was 750 million minus, ladies and gentlemen, accumulated depreciation of 370. Accumulated depreciation of 370. So 750 minus 370. So this one here, ladies and gentlemen, is giving us what figure? Is there somebody who can give me the figure here? Is there somebody who can give me this figure? So according to Yvonne, a very good student, user there, also user is a very good student. So we have here, net book value is 380. And therefore, we have, I can see straight away, I got revenue of 260 and the asset was worth, in this case here, 380. Are we going to make a profit or a loss out of this disposal? Are we going to make a profit or a loss out of this disposal? Are we going to make a profit or a loss out of this disposal? It's a loss straight away. These are loss on disposal. It's a loss on disposal. Because you know, to make our loss or profit, we take the revenue received minus our cost. This cost is the carrying cost, the carrying amount. So it will be 260 minus 380, which gives me minus, but because I've used the word loss, I will write it in this case here as 120. Is that okay? Riley is giving me a figure of 120 loss. I'll take the modulus. I'll take the magnitude here. Don't write negative. Then I'll be able to come in this case here on the loss on disposal. I'll be able to write 120. So the question is, should it be negative here or positive? Should it be negative or positive? Should it be negative or positive? It will be positive because, you know, a loss, they had deducted out of this to arrive at this net amount. Remember, all expenses in these adjustments, all kind of expenses here will be added back. Gains are the ones we deduct because you see if it's a gain, they had added it and we are correcting. We are making adjustments, colleagues. Colleagues are making adjustments there. All right. So at least this one, all of us, we are what here? We are pretty comfortable. We are pretty comfortable. We are pretty comfortable. Now, ladies and gentlemen, this examiner was a little bit tricky on depreciation. You know, most of your examiners will give you depreciation. But in this case here, this being a kind of a sadist examiner, he never gave you depreciation. What he did, he gave you provision for depreciation on what, number one, as accumulations. Accumulations here. So there is no problem. That one I should be able to just do a working for what here, for this provision on depreciation for me to get my P&L depreciation. Because you know depreciation, of course, given published accounts, depreciation cannot be given in the income statement directly. No, it will be part of cost of sales. So it's not given directly. What good examiners do is to give you the depreciation in the notes. In the notes. But now here depreciation has not been given. So we need to, in this case, here, disaggregate the information that we're given here. Fortunately, I can see balance brought down for this depreciation, for the total depreciation. Is there somebody, remember 2021 is what is brought down from note number 1. 2021 is what is brought down. 2022 is what is carried down. So is there somebody who is able to see for provision for depreciation? Is there somebody who is able to see the balance that was brought down? So according to user, it is 15, 200, and what here? 50. Thank you very much. So in this case here, balance brought down. So we have here balance brought down. So in this case here, we have 15, 200, and 50. And then now we ask ourselves, in this case here, what kind of adjustments are we supposed to be having here? What will lead to my depreciation increasing? What will lead, in this case here, to my depreciation decreasing? So like now here, you guys for sure, you've told me that there is depreciation, that in this case here, we lost some depreciation because of what here? Assets which were disposed. So there is a depreciation for asset disposed here, for asset disposed. Is there somebody who is able to remember that total depreciation for the asset to disposed? It's given here in the second paragraph. In the second paragraph, depreciation. So according to Yvonne, we have 370. So we have 370. Remember, it's a reduction. Depreciation is reducing because that asset went away with its depreciation. That asset went away with its depreciation. So I should be able to capture this in brackets. I should be able to capture this in brackets. I should be able to capture this in brackets. Now, ladies and gentlemen, if you look at this question very well, you'll be able to see on note number 2, we did something. We acquired a subsidiary. We acquired a subsidiary. So in this case, ladies and gentlemen, if you look at note number 2, on 1st January 2022, G Limited acquired 75% of the 100 million ordinary shares of shillings 10 each in S Limited. The acquisition consideration comprised a share exchange on the basis of 2 shares in G Limited for every 3 acquired shares in S Limited. G Limited was also to pay shillings 810 million to the owners of S Limited on 1st January 2023. G Limited's cost of capital is 8%. The market values of ordinary shares at 1st January 2022 were 30 and 20 for G Limited and S Limited respectively. The fair values of assets and liabilities of S Limited at the date of acquisition were as follows. So I can see one of the items that came with this subsidiary is property, plant, and equipment. And here I'm interested in the provision for depreciation. Are you able to see the provision there, ladies and gentlemen? What is the provision there? Provision. But this is an acquired subsidiary. This is an acquired subsidiary, 2,900. So in this case here, we have depreciation. Depreciation for acquired, which came in this case here with this acquired subsidiary. And they're giving me a figure of what here? They're giving me a figure of 2,900. They're giving me a figure of 2,900. So let me ask you a question. Should it be negative or positive? Abracadabra. Let's talk here. Should it be more negative? Add because we acquired a subsidiary. Our depreciation went up. Positive, yes. So then what is the expected total depreciation? What is the expected depreciation here? Total expected. What is the expected depreciation? Somebody who is able to add for me very fast. 17,780. So we have here 17,780. So we shall be able to compare now these with our balance carried down in this provision of depreciation account. So the actual in this case here, total depreciation, which is the balance carried down, So the actual from note number 1, is there somebody who is able to see an actual provision of 19,500? Actual provision of 19,500, 19,500, 19,500. So I can see that there was an increase here. There's an increase. An increase that signifies depreciation for the year. Depreciation for the year. Depreciation for the year. Give me the amount. Depreciation for the year increase 1720. So in this case here we have 1720. How they got this 1720? They have taken this minus this, an increase. They have taken this minus this. So it is this 1720, ladies and gentlemen, that I will work with very fast, and book it here. Depreciation of 1720 like that. Depreciation of 1720. So is that okay, ladies and gentlemen? Are we able to pick something? Is this okay? All right. So most of them are telling me Mwalimu. So let's move on to the next working here. So the next working should be impairment. Impairment is for what here? We normally talk of impairment being the loss in value of our goodwill asset. So impairment is for goodwill. Now listen, my good students. Most of the examiners, again, they do give us goodwill for acquired or disposed subsidiaries. This examiner never gave us that goodwill. So should we cry? Because we acquired a subsidiary. On acquisition of this subsidiary, we need goodwill. And this examiner has not given us this goodwill. So in this case here, should we raise up our hands? For example, mama yo. No. We need in this case, ladies and gentlemen, to do what here? To calculate this goodwill ourselves. We have to calculate this goodwill ourselves. Let's calculate this goodwill ourselves. And by the way, the BDA students who are in the house, are they able to follow The BDS students who are in the house, are they able to follow? The BDS students who are in the house, are they able to follow through Excel? Are they able to do this through Excel? Saumu says yes. Must be a good ninja. It's only Saumu who is able to do it. Also brilliant. Namuli, yes, we shall overcome. We shall overcome. The other ninjas doing Excel. The other ninjas doing Excel. Doing this in Excel. Miriam as well, she's able to follow. Now, so we are looking for goodwill. We are looking for goodwill of the new subsidiary, the one that was acquired in the period. So remember, goodwill, we'll have to look for the consideration that was paid. This was quite a tricky question, but I will be able to handle it very easily. I'll be able to get all the marks in this question. Why was it tricky? Again, this examiner never told us how much the parent paid directly. He told us that it was a share exchange. So then I would want, in this case here, to understand the parent's consideration. The parent, in this case here, consideration. The parent's consideration. So the parent's consideration, you're told on 1st January 2022, G Limited acquired 75% of the 100 ordinary shares of shillings 10 each in S Limited. The acquisition consideration comprised a share exchange. So we have, in this case, it comprised a share exchange, and this share exchange, then we'd want to get the value of the shares. And you're told the acquisition consideration comprised a share exchange on the basis of 2 shares of the parent. Remember, you must start with the number of shares of the parent over the number of shares of what here's a fraction over the number of the shares of the acquired subsidiary, 2 for 3. So I'll take, in this case here, 2 for 3 there, 2 over 3. So then what will I do? So 2 over 3 times, in this case here, the number of ordinary shares of the target company, or of the sub, of the new subsidiary, remember, of the sub. 2 over 3 times nose of the sub, you can write that in full, times nose of the sub, number of ordinary shares of the sub. So is there somebody who can tell me the total number of ordinary shares this subsidiary, the new subsidiary, had? Total shares that the new subsidiary had. The one that we are acquiring today. The one we are acquiring in note number 2. It is 100 million. It's 100 million. I shall leave, in this case here, the 100. So I shall, okay, let me just write this for. So number of shares of the subsidiary times, in this case here, the percentage that we acquired. Remember, you're the ones who have told me that, Mwalimu, we acquired 75%. All right, times that percentage acquired. And then, of course, at the end of the day, this will be the shares that the parent gave out. So once I've gotten the shares, the number of shares that the parent gave out in total, then I need to monetize this. To monetize this, I'll take the market price per share of what year? Of the parent company, of the parent core, of the parent company. So whenever you hear of share exchange, just come and give us the fraction. When you're getting the fraction, remember, it is the number of the shares that the parent gave out over the number of the shares of the subsidiary, this fraction, 2 for 3. At times, the examiner will start with the shares that the subsidiary gave out. The examiner will say it is 3 shares from the subsidiary for every 2 of the parent. It's you to know that the parent is always on top. The parent is always on top. So it will be 2 over 3 times number of shares of the subsidiary times the percentage. We acquired 75%. Times, for monetization, we should always multiply this with the MPS of the parent company. So then please go ahead and give me this answer. So this will be 2 over 3. You've told me that this acquired company had 100 shares times 75% times, is there somebody who is able to see where they have given us the MPS of the parent company? MPS of the parent company is anybody who is able to see that. It's given there on still not number 2, but the last paragraph. The market values of the ordinary shares at 1st January 2022 were 30 and 24. G, I want G. The one of G is 30. So can somebody in this case then give me this share exchange? This share exchange amount So they're giving me a figure of what year? 1500. 1500. Thank you, Maggie. They're giving me a figure of 1500. 1500. So all of us, are we comfortable with this? Is this a formula that you can have a look at later? Is this a formula that you can have a look at later to understand it even better? All right. So then that is share exchange. That is share exchange. And then now, but ladies and gentlemen, there was a cash consideration. There was a cash consideration, but this cash was not to be paid today. So we are told here, the acquisition, that is not number 2, second sentence. The acquisition consideration comprised a share exchange on the base of 2 shares in G Limited for every 3 acquired shares in S Limited. G Limited was also to pay 810 million to the owners of S Limited on 1st January 2023. Remember, this acquisition happened on 1st January 2022, and then we are required to pay 810 million a year later. So whatever we shall be paying later is known as a deferred consideration. Is known as a deferred consideration. So we shall come and mention here deferred cash consideration. How much is it? How much is it? It is 810. This 810 is futuristic. If it's futuristic, then we shall discount it. So in this case here, times PVIF, 8%. Remember, we are paying this thing exactly 1 year from today. We are paying this thing exactly 1 year from today. We are paying this thing exactly 1 year from today. Because the 810 is going to be paid in the future. So we need to bring it to its present value. We need to bring it to its present value. So, and I hope, great friends, colleagues, you are able to remember the formula of PVIF. It is 1 plus R raised to negative N. Raised to negative N. It is 1 plus R raised to negative N. Raised to negative N. We look at this. AFRA, April 2023, question number 5. So PVIF, ladies and gentlemen, is 1 plus R raised to negative N. So this will be 810 into 1 plus the cost of capital. The required return is 8% in the question. They've told us there. The cost of capital is 8%. 8% raised to negative 1 because you're going to pay this amount by January 2023. Raised to negative 1. So Fred and Gatti, I mean, are you able in this case here to take 810 times this figure directly? 810 times, open brackets, 1 plus 0.08, close, raised to negative 1. Miss Karanja, thank you. Juliana, thank you. So you're getting deferred consideration of 700 and what year? Of 750. We are getting deferred consideration of 750. So up to there, ladies and gentlemen, are we okay? In terms of purchase consideration, are we okay for the parent? Are we okay? All right. So do we have any stakeholder who came on board to assist us buy this subsidiary? Oh, yes. We only bought 75%. There is somebody else in this case who came and acquired 25%. There is someone else who came and acquired 25%. So 25% acquirer is the minority, is what we call the NCI. So we have, this is the parent's consideration. We have NCI's consideration. NCI's consideration. This was a tricky examiner. In most cases, we are given the NCI's consideration automatically. They tell us that the fair value of NCI at acquisition was maybe 1,000. Here they have not told us. What they've told us in note number 3, the group policy is to measure NCI in subsidiaries at fair value at acquisition dates. Fortunately, we know that this gentleman took 25%. 25% of the subsidiary, which is 100. And fortunately, we know in this case here how much the share of the subsidiary, MPS of subsidiary. Fortunately, we know, you can't use MPS of the parent here. You can't use MPS of the parent here. You can't use MPS of the parent here because, I mean, these guys are not going to give the parent shares as well. No, then they're buying. So then this one here will be 25%. 25% times 100 times what here, somebody? Times 100 times what here, somebody from note number 1, note number 2, I mean, note number 2, there's a place where they gave us, in this case here, the market price per share of S Limited, which is 20. So then are you able to give us the final answer here? NCI is consideration. NCI is consideration. NCI is consideration. NCI is consideration. Wanasema ati ni 500. Ati ni 500. Now, ladies and gentlemen, the moment you've been able to get these, then I should be able to come and subtract the net assets acquired. So we less the net assets acquired. Less net assets of the sub. Net assets of the sub acquired. Less net assets of the sub acquired. Are you able to see that figure from the table given? Is there somebody who is able to see the figure from the table given? You can see the fair values of assets and liabilities of S Limited at the date of acquisition were as follows. So then the net assets figure that I'm able to see there is 2,500, Juliana. Thank you. 2,500. So net assets of the subsidiary, 2,500. This is what you're subtracting. So then are you able to give us the goodwill of the subsidiary acquired? So now you should be able to take this, NCI's value, minus this 2,500 for you to be able to get, in this case here, the goodwill on acquisition. So goodwill on acquisition. Goodwill on acquisition. Yvonne is telling me 250. Thank you so much. So close that one. It's a close deal because, you know, here, there is no policy for any impairment. They can't give you. So this is the goodwill on acquisition that we have there, 250. So up to there, ladies and gentlemen, are we able to follow? Ladies and gentlemen, up to there nicely? Because goodwill for the acquired subsidiary has to be calculated if it's not given. Even the disposed subsidiary, the goodwill, if it's not given, it has to be calculated. It must be calculated. Now, ladies and gentlemen, from that, then I'll be able to look at the changes in the goodwill account. The changes in the goodwill account to be able to derive now the impairment. Changes in the goodwill account. No, it's not challenging really because, you know, once you are told that an amount will be paid in the future, we call it deferred consideration. So I hope you'll be able to identify it in an exam. Then you should be able to discount. Net assets, if you look at the group, note number 2, where we acquired this company called S, you can see the assets given there, last sentence. You'll be able to see in this case here, 2,500 on that table, 2,500 on that table. Are we together there? So then come and give us changes in the goodwill account. So we want to get impairment loss. For us to do that, we must get changes in the goodwill account. So give me the balance brought forward. Balance brought down. Look at the goodwill account in the balance sheet. Look at the goodwill account in the balance sheet. Sound is giving me a figure of 4140. Balance brought down is 4140. Is everybody in the balance sheet? Is everybody able to see that? You know, brought down is 2021. Carried down is 2022. So balance brought down is 4140. So we add goodwill of subsidiary acquired, acquired in the year. So goodwill of subsidiary acquired in the year is how much? The one we have just computed. It is 200 in what year? It is 250. So, and that is it really. So this is the goodwill you expect at the end of the year. Expected goodwill. So expected goodwill, what do we have here? Expected goodwill, 4390. So we expected to get 4390. But how much do we have there? Actual goodwill. So of course, this will be the balance carried down. In the balance sheet. How much do we have there? Balance carried down in the balance sheet, and that is giving me a figure of 4,200. So then what do you think in this case here happened? What do you think happened here? What do you think happened? You can see goodwill going down. That's what we call impairment loss. So impairment loss will be this minus this, which gives me how much? Which gives me how much? 190. So impairment loss is 190, like that. That's what you bring here. Impairment 190. Amortization is dash. Impairment, Alango is confirming. So up to here, ladies and gentlemen, are we together up to here? Are we together up to here, ladies and gentlemen? And of course, this is a free class. I'm so sure there must be some ninjas who are not from RCM. They need to join this great college. They need to join this great college for revision and even, for example, if there is a ninja here who is speculating for August sitting, join us. And for you to join us for any inquiries, I would want you guys to call this number, 0793 555 triple. Honestly, how do you expect to stay away from this kind of training? This is the best training in Africa. 0793 555 000 is the number that we would want you to call. So we continue reading, ladies and gentlemen. We continue reading, ladies and gentlemen. So I want us to do something very nice there. I want us to do something very nice there. Something very nice there. Something very, very nice. Let's read note number 4. Note number 4. Investments at fair value through P&L consist of highly marketable and risk-free securities. Leave that one out. Any impairment loss on goodwill is included in administration expenses. Leave that one out. Leave that one out. Now, ladies and gentlemen, because I've been able to do this depreciation, I would want somebody to do the PPE account, the movements in PPE. The movements in PPE. I'm really interested in the movements in PPE. Is there somebody who can do that for me? The movements in PPE account. This will not be a tough order, really. 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 The movements or changes in the PPE account. So in the PPE account, what do we have there, ladies and gentlemen? We have balance brought forward. So balance brought forward for the PPE. Is there somebody who is able to see an amount of 14 something? Go to the balance sheet. Go to the balance sheet. Go to the balance sheet for property, plant, and equipment. We are able to see 14,750. 750. 14,700. So what makes this PPE in this case here dance? Like, for example, when we have revaluations, when we have, in this case here, depreciations, or new acquisitions, or disposals, those ones will always affect here. And yes, we had in the period depreciation. In the period, we had depreciation. Of how much? Depreciation of how much? 1720. 1720. Now, ladies and gentlemen, remember, we brought, this is supposed to be a deduction against assets. We brought in a new subsidiary. We brought in a new subsidiary. We brought in a new subsidiary. So this new subsidiary came in with depreciation. The new subsidiary came in with depreciation. Is there somebody who is able to see that depreciation coming from the new subsidiary, abracadabra? Oh, they are not talking to me. They are not talking to me. 2,900, isn't it? So we have here acquired subsidiary, acquired subsidiary, acquired subsidiary. So this acquired subsidiary, they're giving me a figure of 2,000 what year? 2,900. It came in with a depreciation here. 2,900. Thank you very much. That's acquired subsidiary. And then remember, we disposed an asset. Do you remember we disposed an asset? We disposed an asset that went away with our depreciation. We disposed an asset. So disposal of equipment here. No. Here we are wrong. We're supposed, not the depreciation. We're supposed to work with the PPE. PPE. So acquired subsidiary came up with in this case here, we came up with a PPE item. So are you able to see in this case here, any PPE item that we came with? Any PPE item that we came with? Sorry for that. PPE item that we came with. Ladies and gentlemen, note its depreciation. Remember the PPE item that we came with this new subsidiary, the value was 5,000 and it had some depreciation there of 2,900. So basically this acquired subsidiary PPE is supposed to be 2,000 what year? 2,100. And then in this case here, we have an asset that was disposed. Asset disposed. Asset disposed. So the asset disposed, I'm looking at the net book value. Net book value. So this asset that was disposed in note number one, during the year ended 30th September 2022, G Limited disposed of an item of equipment for cash proceeds of 260. The equipment had cost 750 and had an accumulated depreciation of 370. So the net book value there will be 750 minus 370. So are you able to give me that value? Are you able to give me that value? Are you able to give me that value? So they're giving me a figure of 380. And because the asset was disposed, this should be a deduction. This should be a deduction. All right. Now, from there, we look at our income statement to see whether we have any revaluations. When you look at the income statement, ladies and gentlemen, there is even nothing like other comprehensive incomes, nothing. So no revaluations. So then we are okay. All right. So, ladies and gentlemen, come and give us, and of course, we never acquired, I mean, in the period, there are no those assets which were acquired directly. All right. So come and give me the expected PPE. Please give me the expected PPE. Are you able to give me the expected PPE? Alango is asking why not dispose at cost. It's because of what here? The PPE value that we have, Alango here. Alango, this financial accounting one, we shall overcome. The PPE item, the PPE value that we have in the balance sheet, is that figure at net book value or at cost? Is that figure at net book value or at cost? It's net book value. So everything should be net book value. Even this disposal, net book value. Even this acquired subsidiary PPE, it has to be net book value. Net book value. So expected PPE gives me how much here, somebody? Expected PPE gives how much here, somebody gives me how much? Expected PPE. 14,750. 14,750. So we have here 14,750. So 14,750, ladies and gentlemen, then come and compare this with the actual PPE carried forward. Actual PPE carried forward. Actual PPE carried forward is how much? Look at your balance sheet. Look at your balance sheet. Actual PPE carried forward is at 23,500. So this is 23,500. So I can see an increase here. An increase of how much? Get that difference. An increase of how much? Get that difference. Juliana, thank you. An increase of how much? 87.50. An increase of 87.50. Increase of 87.50 here. It's an increase of 87.50. 87.50. So in this case, ladies and gentlemen, what would you make out of this 87.50? What would you make out of this 87.50? What is it to us? Gain? No. Thanks for trying, but it can't be gain. This is the acquisitions, the assets purchased in the period. So the new assets purchased in the period. So in this case, it's not a disposal because we can see we gained here. So we have here new assets purchased in the period. New assets purchased in the period. Thank you so much. So now, hey, you ninjas, where do I take this cash flow of 8750? Where do I take the cash flow of 8750? Which section of my cash flow? Which section of my cash flow? In investing, yes, because we bought assets. We have invested here. So you're right. So this 8750, I want you to look for investing activities and I say there, new assets bought. New assets bought, 8750. New assets bought, 8750. Investing activities and investing activities, new assets bought, 8750. So I was just trying to do this to see whether there is anything that I could borrow. Maybe like, any gains. Nothing really here. So then what I want you guys to do, for Mwalimu is a favor here. I want you to go to your income statement. Please, let's go to our income statement. And in the income statement, I want us to put a mark on our PBT. I want us to put a mark on our PBT. Before we go there, can I rub this? Can I rub this? Can I rub this? Can I rub this? All right. Thank you very much. All right. 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 So in this case here, we go to our income statement, specifically the profit before tax. I can see a profit before tax, of course, then the income statement is 3440. So we want to identify any non-operating activities in this amount. Any non-operating activities in this amount. So we shall be able to go up. Remember, operating activities are only three. We have revenue is an operating activity, every other day revenue. We have, in this case here, cost of sales. There are only three. We have operating expenses, only three. Operating expenses, only three. Any other item feeding onto this 3440, which is not among as the three, is non-operational. Is non-operational. But again, remember, sometimes these operating expenses could be split into two. We have administration and distribution. So when we look at the figures above this, and then we see something like, for example, profit from an associate here, that is fake. It has to be adjusted. If we see something, for example, like any gains in shares, that's fake, because gain in shares is not an operational, it's not a day-to-day thing. In any, for example, profits on profits or gains on disposal of subsidiaries, that will. So let's walk up. Let's walk that journey. So on top of that 3440, what do we have? The first item that we have there is finance. What here? Finance cost. So is finance cost operational or non-operational? Is finance cost operational or non-operational? We are talking here. Is finance cost operational or non-operational? We are talking here. Operational, non-operational? Non-operational. Unfortunately, we have it already here. Non-operational. Fortunately, we have it here. We have it here. Now, from there, ladies and gentlemen, please move up. When you move up, we have fair value gain on short-term investments. Fair value gain on short-term investments. Fair value gain on short-term investments. I would want you to put a star. Don't write it here, but just put a star on that one. I will explain. Put a star on that one. Put a star on that one. I'll explain later why we're not bringing it here, even though it's not what here, not operational. Just put a star there. Let's walk up. Administration, distribution, those are operating expenses, good. Cost of sales, good. Revenue, good. Revenue, good. So then we are good, apart from this thing which you have put a star there, which is called fair value gain on short-term investments. Apart from that, we are good to go. We are good to go. So in this case here, we don't have any gain on disposals like that. So then we can now easily go to the working capital changes. So under working capital changes, remember we use which acronym? We use OC, O minus C. In this case here, we shall come and take here plus acquired subsidiary metrics, because we are adding, because we acquired, unlike yesterday where we subtracted. So let's start with receivables. So receivables, is there somebody who is able to see the opening balance of receivables? Is there anybody who is able to see the opening balance of receivables? Opening balance of receivables. Wait, they're not talking to me. I don't know why. Opening balance of receivables. If I go to the balance sheet, under current assets, opening, I can see 70-10. I can see 70-10. 70-10. Minus, in this case, ladies and gentlemen, closing receivables. Closing receivables, what am I able to see there? Trade receivables closing 74. Closing receivables, what are we able to see there? 74-20. 74-20. The subsidiary that we brought on board, the subsidiary, did it come with any receivables on board? Did it come with any receivables? Please go to the subsidiary that we acquired. Please go to the subsidiary that we acquired. In note number 2. In note number 2, does it have any receivables? Yes, it is 650. So please give me that answer. Give me that answer. Please give me that answer. Give me that answer. What I said, it is 200 what year? It is 240. It is 240. It is 240. It is 240. Is there somebody who is able to get that figure? 240, somebody, thank you very much. So then I can grab this and write here 240. So am I going to have it as positive or negative? Am I going to have it as positive or negative? If I'm using this concept of OC, I will not be bothered about whether it was an increase or a decrease. That is bad language. You don't have time for that. So long as you're able to remember the language of what here, the language of O minus what? The language of OC, then you are sorted out. OC, then you are sorted out. What we said now yesterday's class, you should never confuse and work with CO. CO means what here? Core. I said I will never work with CO myself. This thing of using a core is not very good at my age. It can bring confusion in life. You know, core things are not very good. Shared. Like core wife, they're not very good. We say we shall not be using core. We shall not be using core. We shall not be using core. That's what we say now. We shall be using OC. OC. Opening minus closing. So then let's go to the inventory. Let's go to the inventory, the change in inventory. Change means you're subtracting. So inventory, is there somebody who is able to see the opening in inventory? Is there somebody who is able to see the opening in inventory? Anybody who is able to see the opening in inventory? I'm alone, but I will overcome. In the current assets, opening inventory is 7660, 7660 minus closing, which is what here? Closing, which is what here? Somebody 89? Is it 8900? Closing. 8900, 8900. The subsidiary that came on the board, the sub that came on board, did it come with any inventory? The sub that came, yes, it came with 820. So long as you're using OC, if you get the figure being negative, you use it as negative the way it is. If we get it as positive, we use it as positive the way it is. So what are we able to get, ladies and gentlemen? According to Juliana, it is minus 420. It's minus 420. So according to Juliana, it's minus 420. And then, ladies and gentlemen, we go to payables. Payables, the same. But payables, remember, it's a liability. Whatever you get here, you have to multiply it with the -1. You must change the sign. Payables is liability, but we're still using OC. We're still using OC. So for payables, ladies and gentlemen, what do we have here for payables? Are you able to see the opening balance? Opening balance 1021 for OC, 9750 from Caroline, 9750 from Carol. Are you able to see the closing? Are you able to see the closing? The closing. Are you able to see the closing? The closing in inventory. They have given me a figure of what here closing, not inventory, but payable. Closing payable, closing payable. In the payables account, we can see 9790. Opening payables, remember it's payables. Opening is 8750. Minus, in this case here, closing, which is 97, closing is 9790. How about the company that we brought on board? Does it have any payables on it? With it, did it come with any payables? It is 1200. Don't be confused and subtract. It's supposed to add. You add there. So then give me the net figure. Whatever figure you get, multiply to the -1, and then you give me a figure to write here. You give me a figure to write there. Abracadabra, what do we have there? Abracadabra, what do we have there? Abracadabra, what do we have there? Have you been able to subtract? There? -160, yes. -160. So I'm being given a figure of -160. -160. Now I would want to give you exactly 2 minutes. You try computing the tax paid for me. I'm giving you 2 minutes. You try to compute the tax paid for me. I'm giving you exactly 2 minutes. Try computing the tax paid for me. Try computing the tax paid for me. Try computing the tax paid for me. Tax paid. Try computing the tax paid. Try computing the tax paid. Anybody who gets this should be able to get a present from me. Tax paid. Tax paid. Tax paid. Tax paid. So long as you master this, ladies and gentlemen, you will never go wrong. These are easy workings. Very easy workings. Very easy workings. Very easy workings. So remember, for tax paid, you will take in this case here the opening current tax. So we have in this case here the current tax. So current tax opening, plus in this case here deferred tax opening. You subtract in this case here current tax closing plus deferred tax closing. You add in this case here any P&L tax, P&L tax. And then of course you make adjustments, against what here? The acquired subsidiary. So CT stands for current tax. So remember these two, you are getting them from the balance sheet. Everything here, you're getting it from the balance sheet. P&L is only once. So ladies and gentlemen, for 2021, is there somebody who is able to give me the normal tax? 2021, the current tax, 2021, the current tax, what do we have here? 2021, the current, how I wish I would get like just three students. So current tax and the current liabilities, we have 500 what here? 580. Plus, ladies and gentlemen, the deferred taxation opening, 2021. Deferred tax opening is how much? 450. It's 450. And then you will come and they say here minus the closings now, the closings. So we start with the current tax closing for 2022. What do we have here? Current tax closing for 2022? 745. So we have here 745 plus deferred tax closing, 2022. Deferred tax closing, how much? 620. 620 like that. 620 like that. Plus, ladies and gentlemen, any P&L tax. So P&L tax there. What do we have? P&L tax there. What do we have? 880. If you go to the P&L, you'll be able to see we have an income tax expense of 880. All right. Now, ladies and gentlemen, we go to the subsidiary that we bought. This subsidiary that we bought, ladies and gentlemen, what is happening here? The subsidiary that we bought, in this case here, the subsidiary that we bought, it has, current tax is refundable, it's an asset. So current tax asset and deferred tax asset. So remember, these ones, because there are assets in form of taxes, there are our incomes here. They're going to reduce our tax what year obligation. Remember, this P&L is tax for the year. It's an expense you're supposed to pay. But now because these are assets, tax assets, which we have, if you add, it's like your tax is going up and your tax is supposed to go down because you're both tax assets. So in this case, we need to come and subtract. How much? Both, you combine both. 20 plus 110, because they are assets, both of them. 20 plus 110, that gives me 100 what here? 130. If they were, for example, tax liabilities, I would have added very comfortably because like P&L, your tax is going up. But you see, they are tax assets. Because one is a refund, the other one is a deferred tax asset. So you consolidate them. So then what is the tax paid, ladies and gentlemen? They're giving me a figure of 400 what year? They're giving me a figure of 415. And because it's tax, even the language, tax paid is 415 negative like that. And that is it. Come and give me the cash from operating activities. The one that I told you guys to put a star there, this one on fair value gain, on short-term investments, on short-term investments, there is a last part I'm being told. On short-term investments, this one that we said you put a star there. Remember, short-term investments are what? You're like receivables. All right. Those ones are basically our day-to-day. They are our day-to-day. They are no more. They are no more. They are no more. So ignore that one totally. The last sentence in this case here, the goodwill, we've been able to factor it out. We've been able to factor it out, so that will not affect us. So is there somebody who is able to give me this net cash flow from operating activities? Net cash flow from operating activities. Once I finish this, I've finished the question now. I'll not have any issue moving forward. So please add up and they give me the total 49.95, 49.95. HP is confirming 49.95. The 130, where did we get the 130? The 130, remember 130, if you look at the subsidiary we bought, not number 2, the table given there, you'll be able to see current tax of 20 and deferred tax asset of 110. Remember, you're combining CT and DT. And because both of them are assets, they're assets because the current tax is refundable, it's an asset to the company. So 20 plus 110 loose and A will give us 130. Susan is confirming this 49.95. 49.95. So this is the first section. So I'm so happy with this. The first section, I'm so happy with this. Now I can rub here. Why subtract? Good questions are coming there. Why subtract? Remember, if it's a tax obligation, I don't know how you do it at your workplaces, but when your tax increases, what are you supposed to do? When your tax is going to increase in this account, what you're supposed to do is to add. Like now we got P&L, the tax in the P&L. So this is supposed to increase. If, for example, the subsidiary we brought here came with tax obligations, I should have added to show that my tax is increasing. But instead of coming with tax obligations, it came with tax assets. So the tax asset should be reducing my overall tax. So I should be able to come and deduct like that. Deduct. I should be able to go there and deduct. All right. So, ladies and gentlemen, in this case here, we have this 49.95. They're saying that payables is wrong. Payables is wrong. Where are payables? Payables. Does it have a problem? 415. I'm getting a different figure. Where is 415? 415. Tax paid here. Use your brackets. Use brackets well. Open brackets 580 plus 450 close minus open 745 plus 620 close. If you don't use your brackets well, you cannot get it right. Plus 880 minus 130. You'll get 415. You'll get 415. You'll get 415. You'll get 415. Payables is okay. Selena is saying, I thought anything payable, we add. Payables were 8750 minus 9750. Celine, angalia, hiyo mambo ya add back ni hapa wewe Celine. Naona hapa. Hapa juu. Naona hapa ikitu kabla working capital. Hiyo ni story ya huku juu. Expenses you add back. And then gains you subtract. Lakini huku chini huku, hapana, ukisema jina paid, lazima utaandika negative. Huku chini ya maneno hakuna. It's different, yes. It's different, yes. All right. Kuna mwenye anasema bado ati payable. Luciana anasema ati payable inafaa kuwa namna gani? Asante. Payable inafaa kuwa 870, 8750 minus 9790. And then we have a payable that came here of 1200 with the acquired subsidy. Now, what Luciana is forgetting is that payable is a liability. Whatever answer you get, finally, you must multiply it with -1 to change the answer. That's what we are writing here, times -1. Luciana, are we together now? Are we together, Luciana? Are we together? Are we together? All right. Thank you so much. So then let's go straight away to investing. Now, investing will not take us even 5 minutes. The bulk of the work is done. So investing activities. Slow tumalize. Hata hii bado ni low hanging activities alango. Pole pole, twende pole pole. Twende pole pole. Twende pole pole, twende pole pole. Kwanza jaribu ku understand kwanza. Because yesterday I realized, you know, even if I want to show you guys low hanging fruits, yesterday I realized most of you are not able to follow. So first of all, let me take you through the entire, and then I'll be able to tell you the fruits to pick. Twende pole pole, twende pole pole. So investing activities. So investing activities, already we have two of them. We sold an asset. Remember there was a disposal of an asset. Disposal of an asset. Which gave us how much cash? Which gave us how much cash? Which gave us how much cash? 260. Then we have in this case here, acquisition of assets. Already we have these two. Which led to how much? If you remember, 8,750. 8,750. We don't have any other. This is the net cash flow. Net cash flow from investing activities. From investing activities. We don't have any other investing activity. Nothing. Give me a value. 90-10. Don't add. Don't add. Remember, acquisition of assets here is a cash outflow. Assets came in, money went away. Money went away. Money went away. Don't add. Please remember, one is positive, the other one is negative. We shall overcome. We shall overcome. We shall overcome. 84.90, isn't it? 84.90. Thank you very much. I hope everybody is able to pick this. I hope everybody is able to pick that. So is that okay? Remember, one is an inflow. When you sold an asset, money came in. When you acquired assets, money went away. One is an outflow. So are we together there? All right. Thank you very much. Now, after that, ladies and gentlemen, we go to the financing activities. Quite straightforward. Quite straightforward. So we are now in the financing activities. So financing activities. Financing activities. So financing activities, you look at your financed by items. You look at equity and liabilities. Look at equity and liabilities. Look at equity and liabilities. So we begin with ordinary share capital. Ordinary share capital. This is quite a tricky one, but very easy. Ordinary share capital. Let's look at ordinary share capital. So remember here, you will take ordinary share capital plus any share premium. Any share premium, you add. So in this case here, ordinary share capital, we start with the opening. So opening, what do we have? Oh yeah. Are you able to see the opening, ladies and gentlemen? Opening, ordinary share capital. Look at the balance sheet. Opening share capital, I have 15,000 plus 3,000. We have 15,000 plus 3,000. That is opening. All right. Why am I adding? Because we must prepare one account. We normally prepare one account for share premium and ordinary share capital. We prepare one account. So because we want the change, come and subtract, ladies and gentlemen. In this case here, come and subtract what here? Come and subtract the closing. So closing, what are you able to see there? Closing share capital. 20,000 and 4,500? 20,000 and 4,500. 20,000 plus 4,500. Now, ladies and gentlemen, remember we had some new shares that were issued. Is there somebody who is able to remember the new shares that were issued? Is there anybody who is able to remember the new shares that were issued, abracadabra, when we acquired the subsidiary? The parent issued new shares. The new shares went up 1,500. It was 2/3. If I remember very well, it was 2/3. 2/3 times 100 shares times 0.75 times, was it 30? Was it 30? Was it 30? Was it 30? Yes. We have this working somewhere. We have this working somewhere. 1,500. So they're giving me a figure of 1,500 here, plus 1,500. So then give me the final figure. How much do we have there? Give me the final figure. So these also are free mark, really. I don't take this seriously. And remember, in most cases, you'll not even be issuing new shares. In most cases, you'll not be issuing new shares. So how much do we have here? 5,000, right? 5,000. Positive or negative? Positive or negative? So under financing activities, the first one, you simply mention there, shares. You simply tell us shares there. Shares there. And remember, ordinary shares, these are normally categorized as what? They are normally categorized as liabilities. If you want to get it right, if you don't want to get into many arguments, they are normally categorized as liabilities. As liabilities. So whatever answer you get, if you don't want to go like, we issued new shares, we did blah, 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 koso, no. Whatever answer you get there, you say times one, times -1, I mean. Whatever answer you get there, you change the sign. So if you got -5,000, you say times -1, you change the sign, which gives us how much somebody here, which gives us how much somebody here. Because remember, for liabilities, we said we must always multiply with -1. Always, liabilities. And remember, equity and liabilities are always in the same section. So in this case here, shares, 5,000. So of course you got money. So you can even now go and mention here, shares issued. Shares issued. Or just leave it like that, shares 5,000. Shares 5,000. Mahali kachwa diko ni hapa tu. Ukijua combine hizi, uko mbele sana. Now, ladies and gentlemen, apart from these shares that were issued, go to your income or other balance sheet. Sorry, go to your balance sheet here. So you can see ordinary share capital, you can see share premium. Already you have taken care of those two. So from there, I can see retained earnings. What do we normally use these retained earnings for? You, my good students, what do we normally use retained earnings to get under financing activities? Dividends paid to parent shareholders. Dividends paid to parent shareholders. You guys are clever. Dividends paid to parent shareholders. Unawezana nayo? Unawezana na hiyo marking kweli? Can I give you a minute to try it? It's the easiest. Kwanza hii haina mambo ya OCE. This was a very good examiner. Haina mambo ya OCE. So in this case here, parent investors have invested with us. We need, they have financed us. We need to give them their dividends. We need to give them their dividends. So I'm giving you exactly 1 minute. We see whether you will be able to bell that cut. Let's see whether you'll be able to bell that cut very nicely. Let's see whether you'll be able to bell that cut very nicely. Imagine look at the changes in retained earnings. So balance brought down. Thank you very much. Retained earnings account. So balance brought down. Are you able to see the balance? Are you able to see the balance? Are you able to see the balance? 370 is correct. Who is this ninja? This is Kelvin. That's correct. Are you able to see the balance brought down? Retained earnings. 2021. Retained earnings. We have 3,000, isn't it? No. Retained earnings is not 3. It's 43. 4340. 4340. Now, this retained earnings will increase because of the P&L. So give us the profits, P&L. The profits in this case here for the parent only, the one attributable to the parent. The one attributable to the parent, look at the P&L. The one attributable to the group owners, the parent. It is 20 what here, somebody? It is 2040. It is 2040. So then this is what we expected because we don't have other components of equity. So the expected retained earnings is how much? The expected retained earnings is how much? The expected retained earnings is how much? Expected retained earnings is how much? Expected retained earnings, you add the two. You add the two, we are getting 6380, 6380, and then we'll be able to come and compare this with the actual retained earnings, the one that is being carried down or carried forward. So in this case here, the actual, what are you able to see there, ladies and gentlemen? The actual 1610. And today you guys are very nice. Hey, what is not happening? It's not like other day. Today you guys are very, you must tell me the secret. You must tell me the secret. You must tell me the secret. You seem to be following, like, I mean, you've never followed these things before. And you are very serious. What happened? Or is it the exam which is very close? There must be something. This is abnormally good. You should tell me the secret, really. Okay. I can see students saying generally float. Some of them told me yesterday they again followed. They followed. Exactly, Kodia. So in this case here, we can see retained earnings have reduced. Retained earnings have reduced. So when retained earnings reduces, it's because you paid out dividends. So dividends paid to parent. Dividends paid to group owners, to parent. Unasema ni ngapi somebody? 370. 370. So then come and mention here dividend paid to parent. Dividend paid to parent, which is what here 370. So that has to be in bracket. That has to be in the bracket. That has to be in the bracket. Of course, you have paid the parent their dividends. Why don't you pay dividends to NCI as well? Pay dividends to NCI. They're the minority and you need to take care of them. They're important stakeholders. If you pay dividends to NCI, or rather to parent, the NCI also invested in you. The NCI invested in you. So now look for the dividends paid to NCI. Look, construct the NCI's account. So dividend paid to NCI. Dividend paid to NCI. So you're doing NCI's account. So NCI. So in this case here, you give me NCI brought forward. So NCI brought forward is how much? Look at the balance sheet. Look at the statement of financial position. NCI brought forward is how much? NCI brought forward is how much? Thank you so much. When I get so many responses like that, I'm so sure. But there's something I forgot. There's something I forgot. To ask my BDA students, because you know they're typing, to ask them whether they are able to cope up with my speed. The BDA students will be very fair of me if I'm just moving. Are we together? It can't be 100%, but are we together somehow? BDA. Remember, as a BDA student, you cannot put the computer down and then you start writing. No, as we are past that, we do everything in Excel. At least I have one student, Victor, is also following, BDA student. They're doing this in Excel 100%. They're doing this in Excel 100%. Celine is also following. Great. Thank you so much. So then NCI brought forward is 1080. 1080. Give these guys their year's profits. So give in this case here their profits here to them. Remember, this is for NCI, attributable to NCI. Are you able to see from the income statement how much is attributable to them? How much is attributable to them? 520. Is that okay? 520. 520. But now remember, this one you have to be very careful because we brought in a subsidiary. We brought in a new NCI. There is a new NCI because of the acquired subsidiary. A new NCI because of an acquired subsidiary. Are you able to remember that new NCI? Oh, yeah. Are you able to remember the new NCI? You have to be very careful here. You have to be very, the parent is one. The parent of all the subsidiaries is one. But NCI will keep on changing. So remember this new NCI, was it 25% if I remember? 25% over 100 times something. Something like that. We have this working somewhere. Lizzie Muteto is saying 50. Is it 50 or 500? 500, I think. So please put a star here because that is very important for you. So give me the expected NCI. Give me the expected NCI. How much do we have there? Give me the expected NCI. How much do we have there? Expected NCI. So expected NCI is 2100. Compare this with actual NCI at the end. Actual NCI balance carried forward. Carried forward. So expected NCI at the end, balance carried forward. How much do we have there? $1,840. So of course the reduction means that we paid NCI something. Reduction means that we paid NCI something. How much do we pay them? 260. We pay them 260. So in this case here, dividend to NCI. Dividend to NCI, 260, put in brackets. So go back to your balance sheet. 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 You are looking at non-controlling interest. You have paid them. Now we go to the liabilities. Deferred consideration. That one we have already been able to account for it. Bank loans. Look at bank loans. So bank loans is very easy. Right here, bank loans. Bank loans. Opening minus closing. Opening, in this case here, bank loan. There is nothing really here. 2,600. 2,600 minus closing of what here? 3,000. Minus closing of 3,000. But remember, this is a liability. So don't forget in this case here to multiply with a -1. So what do we have here? Somebody, bank loan. Opening minus closing. No, I did the opposite. I did the opposite. It's supposed to be 3,000 minus 2,600. Thank you, Aggie. 400, yeah, right? But negative, isn't it? Because the loan reduced. Whatever you get here, remember, these are liability times -1. So liability, you must change or use the T accounts which you're used to, if you like T accounts. I hate them. I hate them. So after that, who is able to tell me the very last thing we need? Because now we have cleared this section of the financed by the equity and liabilities. What do you think now should be the last transaction here? What do you think will be the last transaction here? What do you think will be the last transaction? Finance cost, yes. Finance cost. Finance cost. So finance cost, are you able to see, do we have any interest obligations in the balance sheet? No. No interest obligation. So it's 0, 0, 0, 0. So the only finance cost that is of interest to us is finance cost for the current year in the income statement. Are you able to see it? The finance cost, 280. But now remember here, we have the deferred consideration. Whenever we have deferred consideration, remember we took in some interest. If you remember deferred consideration, we were able in this case, ladies and gentlemen, to do what here? To discount. When you discount like that, it's like you are paying interest. And that interest has to be unwound. We talk about unwinding of interest on deferred income. So this loan that you were given, you can take it as a loan. You take it as 800. Remember the present. Are you able to remember the present value? These guys are forgotten. The deferred consideration present value. The one that you took the goodwill account, 800. And what in this case here, what is the rate of interest? The rate of interest is 8%. The rate of interest is 8%. The rate of interest is 8%. And we never stayed with this loan for a whole year. Remember, this subsidiary was acquired on 1st January. Is it 810 or 800? The one after, let me check. The one after, it's 810, eh? Or some it is 810. Goja kidogo. Actually, it is 750. Actually, it's 750 after discounting it. After discounting it, the loan that we were given like today, after discounting it, is supposed to be 750. Is it okay? Check your goodwill. It's supposed to be 750. The loan given today is 750 after discounting. 810, of course, is the deferred, but in this case here, at the end of the day, we have 750 is the loan that was given to us. And the rate of interest is 8%. We never stayed with this loan for a whole year. We stayed with it for how many months? Remember, the subsidiary was acquired on 1st January. And we are doing these financial statements in September. In September. Woi, niko alone. It's 9 months, isn't it? Times 9 over 12. Now, ladies and gentlemen, please allow me to explain something here. Why am I deducting? Remember, as a finance manager, I took in this money that I never paid, which I'll be paying like 1 year from today. I took it like a loan to us. And I was able to calculate that finance cost and lump it here. But of course, you and I know the fact that there is no such loan that I'm going to pay. There is no such interest that I'm going to pay. It's a fake interest. So I have to do what we call unwinding. Unwinding. It's a fake interest because I'll not be required to pay that amount. Unwinding, you deduct. So then are you able to give me this figure 280 minus this? What figure are we getting, ladies and gentlemen, there? If somebody is giving me a figure of 235. Somebody is giving me a figure of 235. And of course, it is interest. You'll assume, not assume, but because you don't have opening and the closing balances, so we'll say the entire amount was paid. So they give me, in this case here, the net cash flow from financing activities. Net cash flow from financing activities. Net cash flow from financing activities. So like now at this point, even if I explained it 200 times, not many students will be able to remember this in an exam. I'm not saying that you guys are stupid. There is nobody who is stupid in this life. Nobody is stupid in this life. It's because of the time limitation in an exam. Or do you want Mwalimu to spend a lot of time explaining this thing? Do you think you'll be able to do it? Of course, you can manage to do it, but do you have that time within 36 minutes? Do you have that time within 36 minutes, really? No. 37:35. 37:35. Thank you very much. 37:35. So this is my C. So then come and give me the total cash flows here. Give me the total cash flows. Give me the total cash flows. So the total cash flows, what do we have here? We have A, operating, plus investing, plus financing. If I'm not wrong, the operating, what do we have in this case here now? Abracadabra. Abracadabra, abracadabra. I'm looking at my figures. You guys have those figures. You guys have those figures. I'm so sure you'll be able to add them very fast. A plus B plus C. Somebody's giving me 240. 240. The total cash flow is 240. Total cash flows A plus B. Operating plus investing plus financing. I'm being given 240. I'm being given 240. And then you add cash and the cash equivalents brought forward. Cash and cash equivalents you add. So for the year 2021, are you able to see any cash and cash equivalents there? 2021, are you able to see any cash and cash equivalents? Cash and cash equivalents. Cash and cash equivalents. Remember, cash and cash equivalents, what do we have under cash and cash equivalents? We have cash at the bank. We have, in this case here, fair value of short-term investments, very short-term investments like it is receivables. All right. We have overdraft. We have overdraft. So, ladies and gentlemen, here we have investments at fair value through P&L. Investments at fair value through profit and loss, those are the short-term investments. So the opening balance there, I will take the cash at bank, which is 240 plus, I'm looking at 2021 figure, plus these investments at fair value through P&L of 2,400. So what figure do we have, ladies and gentlemen, here? What figure do we have, ladies and gentlemen, there? So we are adding the two because it's cash plus cash equivalents. Cash plus cash equivalents. So these short-term investments are cash equivalent. These are the treasury bills. 26. Somebody's giving me a figure of 2640. 2640. So please add 2640 to this 240. 2640 plus 240, please add that to this. 2640 plus 240, please add there. Please add there. What are we able to get, ladies and gentlemen? 2880. I'm being given a figure of 2880 by Victor HP, 2880. So then these should be able to tally with cash and cash equivalents at the end. Cash and cash equivalents, cash and cash equivalents, cash and cash equivalents at the end. Let's try to see whether they are summing up. Cash and cash equivalents at the end. Cash and cash equivalents at the end. Cash and cash equivalents at the end. Look at the current assets. I can see cash at the bank is 310. At the end is 2022. It's not the end of life. So 310 plus, in this case, ladies and gentlemen, the investments at fair value through P&L, which is 2570. 2570. 2570. So when you add these two, is it tallying with this? Is it tallying? Is it tallying? Is it tallying? Is it tallying? It's balancing, yes. It's balancing, yes. Why don't you clap for me for at least for once? I need to feel also happy. Why don't you clap for me? Why don't you clap for me? I need to feel happy today. When we are joking. Now, ladies and gentlemen, we've come to the end of this great session. Of course, when I come now to the next session, I'll be able to teach you how to get the direct cash flows in operations. And that will be the end of that. That will be good. So as we disappear, what have you learned from today's class? What is it that you'll never forget? What is it that you'll never, because this will come in your exam, whether you're doing BDA or you're doing, in this case here, AFRA, this will come in your exam. This will come in your exam. George, if I were you, I would not even go for any other question. If I were you for your exam, I would do this question that you have done today and the one that we did yesterday. That is enough for your revision. Don't go for any other assignment. So what have you learned like you'll never forget? What have we learned that we'll never forget? There must be a takeaway. There must be a takeaway. Opening minus closing plus subsidiary. And remember, when you get an examiner, you know there are bad examiners. When you get an examiner who wants to punish you, he'll tell you a subsidiary was acquired and another one was sold. But that will not really be an issue because I'll say opening minus closing plus acquired minus the sub sold. Rest in peace. Dial God's number. Liabilities times minus 1. Liabilities negative 1. Dial God's number or you rest in peace. Totally, Diana. Totally. And please never forget the concept of what here? The concept of OC. The concept of OC. The concept of OC. So I'll be able to do, ladies and gentlemen, this concept of direct, which will be tomorrow. Tomorrow, again, I have an early morning class. Should I welcome all of you, the evening students? Yes, it is recorded. It's recorded. And actually, if you want, you can go to my Facebook. Today, because it was a free session, I've streamed it live on Facebook. I've streamed this live on Facebook. If you go to Joshua Aura, ACCA Mentor, Joshua Aura, ACCA Mentor, you'll be able to get me there. Joshua Aura, ACCA Mentor on Facebook. And please make me your friend. I don't have many of my students making me their friend. But of course, I understand they're taking me as their father. So they don't want me to see some of the photos they put there. We shall overcome. So look for Joshua Aura, ACCA Mentor. It has been a pleasure, ladies and gentlemen, hosting you. Mwalimu barikiwa paka students wa neighbor wahamie huku. That is what cash flow is very easy. And you see it will be in your exam. Whether you like it or not, it will be in your exam. We have this group cash flow. We have group consolidation. Yeah. Yeah. And I'm so sure there are students who do AFM with us, but AFR, they go elsewhere. Those students normally wamekuwa wametupa mbao. Hakuna mahali pazuri pa AFR kushinda huku. It's a bomba. It is Aura here. Perfect combination. Perfect combination. Thank you so much. Be blessed. Bye. Day by day. The best, yes. The best. Be blessed. Bye-bye. Thank you so much. Please go to your workplaces and be of great service. Be of great service to mankind. Yes, Immaculate, bye-bye. Bye, bye. It shall be well. This week will be great. That's how we prophesy to ourselves. Don't go to your workplaces grooming. No, no, no. We should be happy. We should be happy. We shall overcome. We shall overcome.